Okay, hello everyone. Ashton Chritchlow, Managing Director of Ifamax, and what we're going to do today, just a short-ish video. We've been getting quite a lot of inquiries from our existing clients around inflation at the moment, and whenever you kind of start getting a few inquiries, it probably means that quite a lot of other people are also thinking about the same sort of thing. So we had a little think about what we could do, and we thought putting together a little video might be quite useful so we could share it around. So what I've done, I've got Bernd from GSI that's going to help us with some slides and hopefully cover off the main areas around inflation. So Bernd Hanke, he's the co-investment officer, co-chief investment officer at GSI, and has an illustrious career in the asset management sector to date. And just a reminder, GSI is one of the fund managers that we use for the sustainability side of our strategy. We've been using them for quite a few number of years now. So over to you, Bernd.
Yes, thanks a lot, Ashton. What I'm going to do, I'm just going through this presentation on inflation. I mean, inflation has kind of become a hot topic again, understandably so, because inflation expectations have increased quite a lot recently. I mean, more so probably in the US than in other major developed countries. So if you look at the United States, which is probably going to be a leading indicator for other developed markets, if you look at inflation expectations over time, in the US, you have a survey that is carried out by the University of Michigan on inflation expectations by consumers. And that survey shows that inflation expectations that consumers have increased very strongly recently. So these inflation expectations now are kind of between 4 and 5% right now. And I have to say, this graph actually ends during the second quarter 2021. If we were to update this graph, I think the inflation expectations would actually be above 5%. That's kind of the US case. Inflation expectations nowadays are higher or as high as they haven't really been over the last 10 years. If we look at realized inflation numbers, and this is a graph that looks at inflation rates over the last approximately 95 years, so from 1925 to 2020 in the US, in the United States. And I'll show you other countries and other regions in a moment. So realized inflation rates have increased strongly, as we can see here in this graph. And this graph only goes to the end of the 2020. So if we go to the current inflation rate, the current inflation rate in the US is 5.4%. So it goes above that 5% line, actually. So again, as you can see here, this is a level of inflation that we haven't had for at least 10 years in the US. If we look at other markets other than the US, inflation levels in the UK over the last 95 years, this is what we can see here. In the UK, inflation hasn't gone up that much yet, as in the US. What we have currently is that this only goes to the end of 2020, but what we currently have is the end of June, the inflation rate in the UK was about 2.5%. Then it went down to about 2%, but it's still higher than what we had in recent times. In Japan, the inflation rate is still fairly close to zero. In the EU, so the European Union, the inflation rate currently is about 2%. it is higher than what we've seen over the last couple of years, but not yet substantially higher. But I think the general pattern is that US has substantially higher inflation rates now. The other major economies are kind of lagging behind a little bit, but they're catching up. So inflation, I think, is a major issue around the world at the moment. Now, the question is, what are the reasons why inflation risk may have increased? One reason is that there has been an unprecedented increase in money creation. If you look at money supply, M3, that is kind of one of the money supply measures. That is kind of the broadest measure of money supply. The money supply number M3. If you look at that number for the US, the UK, and on an aggregate level, all of the OECD countries, you can see that money supply has increased. This is the growth in money supply. And money supply has increased very substantially over the last 12 months. And that is kind of one reason, one source for higher inflation. Also, another reason why inflation risk may have increased is that public debt has increased strongly, especially more recently. And what this graph here is showing is public debt as a percent of GDP in these individual countries. So in all of these countries or regions, some of them are regions actually, such as the yellow line. This is just all of the advanced economies. Public debt has increased quite substantially. So there's kind of a little bit of a kink in all of those lines, starting from 2019 to now. In addition to that, inflation risk may have increased due to the bond market kind of signaling that increased inflation. If in the US and in the UK, say, and we can extend that to several other regions, and you have similar findings in these other regions, if we look at, say, in the US, a 10-year treasury rate, 10-year treasury rate is approximately 2%, just below, slightly below 2%. And the treasury rate or yield on, so this is for 10-year treasuries. If you compare that to the 10-year TIPS rate or the 10-year TIPS yield, so TIPS is Treasury Inflation Protected Securities, you have a rate of approximately minus 0.7. If you take the difference of the two, which is kind of the implied inflation expectations or the break-even inflation, that level has gone up by quite a bit since the beginning of 2020. In the UK, this pattern is not quite as pronounced here. If you look at 10-year gilt yields versus 10-year index-linked gilt yields, the kind of the break-even or implied inflation rate or inflation expectations have gone up to some extent towards 4%. And you can see something similar in the EU, for example, as well as in other regions. So increased inflation expectations in many of the kind of major economies within a developed markets universe. So now the question is, of course, how does this inflation or unexpected inflation affect asset prices? We need to be careful here. because what is affecting future asset returns is not expected inflation, it's the unexpected component of inflation. If inflation is higher than what kind of the market consensus expects it to be, then that drives future asset returns. So if you're holding a cash portfolio, then obviously your real wealth is going to be reduced by the inflation rate. If you're holding a bond portfolio, then if there is increased inflation, yields on bonds will increase, because yields on bonds are made up of two components: the real yield plus the inflation expectation. So the nominal yield is the real yield plus the inflation expectation, and if the inflation expectation goes up, then the bond yield increases, and thereby bond prices fall, and that will cause a bond investor losses. If you're investing in a inflation-protected bonds, obviously that is not the case, because you will be compensated for increases in the rate of inflation. Equities, for equities, the dynamics are a little bit more complex. If the inflation rate increases, if it becomes higher and potentially more volatile, that increases economic uncertainty. Economic uncertainty is usually not particularly good for companies, because then all of their decisions, all of their planning is kind of subject to this increased uncertainty, and it makes kind of the life of a company manager a little bit more difficult. Companies may or may not be able to pass increased costs of raw materials onto their clients. So that's an issue. Also, if the inflation rate increases, that may increase kind of the risk premium in the discount rate that is used in order to value equities or stocks, and that may also lead to a decrease in stock prices. Often inflation is also associated with future economic weakness. Therefore, equities are affected by that, obviously, and therefore kind of on average or in the aggregate, if inflation increases, equities are often affected in an adverse manner. If you look at commodities, another asset class, they are often the source of the inflation. So part of the reason why the inflation rate goes up is often because commodity price increase. So if you were a commodity investor, then you might actually benefit from that. However, commodities tend to be a fairly diverse asset class, and some of the commodities prices are related to inflation, others might not be. So I think if you look at commodities, the picture is kind of mixed in terms of whether commodities benefit from an increase in the inflation rate. Okay, so what are the implications of this? We know that cash and bonds tend to perform poorly during inflationary periods, because for cash it's obvious. For bonds, interest rates go up if inflation increases. Therefore, existing bondholders will suffer a loss in their bond holdings, in their fixed income positions. Inflation-protected securities do their job, but they are trading at negative yields now. So they're trading at negative nominal yields now. So it's fairly expensive nowadays if you want to switch to an inflation-protected securities to get that inflation protection, just because the market in general expects inflation to be higher in the future than it has been in the past, at least over the last 10 years. Equities tend to suffer from inflation. They might kind of do a little bit better if you're kind of invested in a factor investing strategy, because commonly used factors such as value, quality, profitability, and momentum, they tend to do slightly better actually in inflationary periods than in non-inflationary periods. Some commodities might actually perform very well during inflationary periods, but other commodities might not do so well. Also, what we need to keep in mind that inflationary periods are not 100% correlated between different countries. And to the extent that inflationary periods are not completely correlated between different countries, so inflationary periods generally do not happen at exactly the same time in different countries. So to that extent, if you hold a globally diversified portfolio, you might benefit from that. So I think what we can conclude in general, first, and this is very important, we need to keep in mind that it's extremely hard to forecast inflation. And it's also extremely hard in our inflation forecasts to distinguish between temporary and persistent inflation forecasts. If any potential increase in the inflation rate is just likely to be temporary, then it shouldn't have a large impact on future asset returns. If it's likely to be persistent, it should have a large impact on asset returns. But it's very difficult to forecast when an inflationary period happens, and also whether that inflationary period is likely to be temporary versus persistent. So given that, it probably doesn't make sense to try to, in your asset allocation, try to time when an inflationary period is likely to happen and when it's less likely to happen, and then shift around your asset allocation. The best strategy is probably to stick with your asset allocation that gives you the highest expected risk-adjusted return overall. And what I mean by overall is that across periods, across inflationary periods, as well as non-inflationary periods. That is probably the safest strategy that you could follow. One thing I wanted to point out here is this is based on a paper, I skipped this early on, by a couple of practitioners and academics. And what this paper or study looked at was the returns of different asset classes during inflationary periods and non-inflationary periods. The paper looked at 3 different regions: the US, the UK, and Japan, which are, basically the largest single country regions in the world. And what that paper found in general is that if you're in an inflationary period, for the most part, as we kind of discussed, equities and bonds are going to suffer. Commodities are going to be benefiting from that period. In other periods, however, commodities are likely to do much less well than equities and bonds. If you just look at the US, during inflationary periods, equities suffered negative returns. In non-inflationary periods, on average, equities didn't suffer. They actually generated positive returns. And I should say, this data is from 1925 to the end of 2020. So it's a 95-year period. Bonds, similar to equities, but even more pronounced, suffered during inflationary periods, and they gained during non-inflationary periods. For commodities, the experience has been the opposite. much higher returns during inflationary periods and almost zero returns during non-inflationary periods. In the UK, you kind of see roughly a similar pattern, although equities have done actually kind of better than in the US during inflationary periods. In Japan, you didn't really have much of inflationary periods over the last 30 years, but earlier on you did have inflationary periods. But roughly speaking, we have the same finding in Japan. What this table also looks at, if you hold a globally diversified portfolio, what was your return experience? And what this shows you is these are the returns of a portfolio that holds US, UK, and Japanese securities, and during periods when none of these countries had an inflationary period. So these would be the returns you would have earned. If one of those three countries had an inflationary period, these would be the returns you would have earned. And if two of the three countries had an inflationary period, these are the returns that you would have earned. So what this shows in general is that first, bonds tend to suffer the most in inflationary periods. Equities tend to be slightly better. Commodities tend to do, at least in aggregate, they tend to do well during inflationary periods. And also, global diversification can help protect returns because inflationary periods usually do not happen in all the different countries in a global portfolio exactly at the same time. So if you hold a globally diversified portfolio, that to some extent protects you from these inflationary periods. So I think that's kind of it. I think the general conclusion is that you shouldn't overreact to increased inflation expectations. If you hold a reasonable portfolio that's a mix of equities and bonds, potentially you might have some commodities in there, you should probably stick to this mix. It doesn't make a lot of sense to try to time whether the economy is likely to be in a inflationary period or non-inflationary period. That is extremely hard to do. And generally, people have not been successful at doing that. So I think it's best not to overreact to increased inflation expectations as long as you hold a well-diversified portfolio.
Brilliant. Thanks, Bernd. That's really good. I think the one of the points you raised was something that I've told clients a few times, is the bit about sort of not everyone's going to be going through inflation at the same time in terms of different geographical areas. So, we tend to get sort of hung up over here thinking we've got inflation coming, and we only really think about UK inflation, where realistically, for all of our clients that have got global portfolios, it's not that big a deal in the grand scheme of things because you've got everyone around the world moving at different paces. So yeah, that was a good point. I've got two quick questions. So this is just two things that clients asked recently, which I thought were quite good questions. So firstly, on commodities, should you just buy them directly and hold them? So should you go out buying gold bars as a hedge against inflation, as an example?
I think that's debatable. It's very difficult, as I said, to time when an inflationary period is going to happen, because the only thing that really drives future returns is unexpected inflation, not expected inflation. Expected inflation is already incorporated in asset prices. If you look at kind of non-inflationary periods and inflationary periods, that type of strategy tends to do not very well.
Yeah.
So I don't think it makes sense to kind of try to time this shifting, say, towards gold and then back into other asset classes. I don't think most people have been able to do that successfully.
Yeah, I thought you'd say that. It's good. And then the other one, which is quite interesting, is more for some of our younger clients potentially with mortgages and debts. What impact does that have on kind of big mortgages, for example, like a persistent bout of inflation?
Yeah, I mean, if you have a mortgage with a fixed interest rate, then an increase in inflation is actually going to benefit you, because it won't affect the interest rate that you're paying, given that it's fixed. But if the inflation goes up, and part of the reason why the inflation rate may go up is because wages or salaries might increase. So your salary might increase, but then your interest rate that you have to pay on your mortgage doesn't increase if it's a fixed rate mortgage. So you actually benefit from an increase in the inflation rate.
Yeah, so it's not all doom and gloom then.
Yeah, that's right.
Good stuff. Okay, well, we'll leave it there for this, but that was really useful. Thank you, and I'm sure our clients will really find that quite valuable. So thanks again for doing that for us. We really appreciate it.
Thanks a lot.